All right, I'm in the picture finally. There we go. All right. Oh, look, there's people. Jesus, how did you guys? I literally was like, I'll do this at in between some other things I was reading. Um, I have a day off, so I don't know, just reading, getting some ideas. Hello, hello. So, anyways, so I figured I'll do this live because I can do it quicker. So I saw this article. It was on Twitter. So also, let me see. Your favorite investor posted, and then some other people did too. So the post looks like retail investors outperformed SPY since 2014. Holy smokes! And then they show this chart. So I was like, okay, what is this? So rather than just blindly post something, I was like, what is this chart? I'm gonna find it and like let's look at this research. So I find the story on Wall Street Journal. So here's Wall Street Journal. Again, find the post, but it's behind a paywall. So I'm like, okay, we still can't find the damn article. Where did they come up with this dumb money outperforming? Because this goes against everything I've ever heard. So now I finally find the article and now I get it. So oh, Andrew's here. Working from home. I see Dave Ramsey was right. Is that what he says? Woo! Oh my god. So needless to say, so I'll briefly. I don't want to show her LinkedIn. There's her name. You can go look at her LinkedIn. She's a journalist. She's got no financial background. So let's get that off the bat. She's never worked in the industry. She used to do, I think, articles on cooking or something in the past. But now, in the last 1 or 2 years, she's reinvented herself as a Wall Street Journal writer on investing magically. So here we go. So you can look at her background if you want. So I'm sure she's doing great work. So there's the chart she puts. Okay. So we look, let me zoom in. Because I hate like the one thing I hate about like these finance YouTubers and Twitter people are just like post it, post it, post it, and move on. And they never talk about it. And it's hard because I got to go back like 2 weeks ago to find this post. And now this is now when I have time to talk about it. Okay. So Vanda Research, this came from a company called Vanda Research. So I go to Vanda Research. I can't find the specific article that they cited the chart. So I look, they do lots of research for retail and investor. They say institutional, but it's all retail based and it's behind paywalls. So I can't find where that chart came from. They do stuff like this. They do articles. It's not really, it's behind a paywall. So I'm sure there's lots of stuff I can't get and I'm not paying anyone. So I think I'm not sure where they get it. So then I can only read what's in the story. So we'll go through this. So they're like, let's see, we'll just go through the highlights for nearly four. So they start off with an example right off the bat of a person that has beat the market supposedly. So for 4 decades, Beckman, so this is the guy, steadily contributed to his employer-sponsored retirement plan, allocated almost entirely to the stock stock funds. Okay, so that doesn't really tell us anything. So he was in his 401k investing in stock funds. That's all we know. I have no idea. He also bought, in addition to that, Apple, Berkshire Hathaway, and Meta. Okay, so he bought tech stocks basically, except for Berkshire. But honestly, Berkshire is kind of like a tech stock at this point. It's just Apple. It's a proxy for Apple to some degree. So they're just using him as an example as the outperformance that they're telling you in this article. So he has $1 million. He's doing well. Okay, so that's how we start this article. I mean, it's one guy. Okay, it's a weird example. We don't know all the background. Wall Street has derided amateur investors, unsophisticated participants buying high, selling low. But the typical investor's long-term mindset and penchant for risk-taking has proved fruitful in technology-driven markets of the past decade. So she's trying to state that retail has been on the tech investment path before the markets, and we have done better retail, dumb money, because we are more innovative and we saw the technology stocks coming, big cap, large cap tech, bro. So apparently that's what she's saying here. Okay. I'm not going to say, we'll continue. The average investor stock portfolio has risen 150% since the beginning of 2014 from this Vanda research. I can't look at I don't know what it says, which is kind of a bummer. So, but there's some interesting things here. It began tracking the data 9 years ago. Okay, 9 years ago. And they're claiming that retail beats the roughly 140%. So we don't know what they're looking at yet. Vanda calculates the average portfolio by analyzing, here we go, individual investors' brokerage account trading activity in the US listed single stocks. The firm's analysis excludes purchases of exchange traded funds and mutual funds. So they're cherry picking their data. This data that she wrote this article on is a cherry picked piece. So they only looked at individual stock brokerage accounts of retail. They didn't look at any exchange ETFs that people might have bought, because people buy all sorts of ETFs, not just indexed ETFs. I've done reviews. There's lots of ETFs. So we're excluding that. We throw that out the window. We're excluding retirement accounts. So any mutual fund investing, they throw that out. They're only looking at this one little slim piece of retail or of investing to state that we outperform the broader indexes. That's really convenient that they just cherry pick the data that confirms what they wanted to write the article about. How convenient. We're going to cherry pick the data that matches our dumb money is outperforming the market thesis in this story. Okay. That's cute. That's cute of her. The typical small investor holds an outsized position in mega cap tech. So again, she's cherry picking mega cap tech, and she's saying that we have more mega cap. We had more tech in our portfolios before the S&P, market cap allocations, efficient market. That's a broad statement. She's done nothing to prove any of this. This is all just opinion. There's nothing to prove this. Although big tech stocks plunged last year, so she's stating that yes, technology has done amazing, and we can look at charts later. So then there's this chart. So, okay, but she's not stated what percentage of these brokerage accounts held big cap tech? Like, what did they hold that proved outperformance? Like, we get no background on this. This is all just a fluff piece. So this is adorable. So she's stating that retail investors that owned large cap tech from 2014 to present have outperformed the indexes. Okay, but what percentage of all brokerage account, what percentage of retail had those types of portfolios? Are you saying a little small amount of people did and they had huge outperformance? Are we doing median or mean? Because this is important. So is it like a small, very tiny part of retail investors were in these large cap tech companies 10 years ago, and they've done amazing, and their outsized returns have now influenced the numbers of the broader, as a whole, retail community, which have underperformed the markets? I'm telling you, you can't deny this. So this is very amateurish writing so far. Whatever. I'm gonna be not. So now if you go into the next example, some other guy. Okay, he invested in stocks when he got his green card. Good for you. His top holdings: Alphabet, Amazon, Apple, Meta, Microsoft. Fantastic. Okay, but she made a statement that all retail is outperforming the indices. Or you just cherry picked one guy that invested in mega cap tech, which short term has done really well the last few years. We're cherry picking our data. How convenient is that? I mean, we're not talking about 20, 30-year periods like people need. No, let's cherry pick small 1 year, 2 year bites of information for our story to get clicks. So, and then we go into online brokerage Robinhood, created an index tracking the 100 most popular stocks, roughly 23 million users. Okay, what does popularity of stocks have to do with the outperformance of the indexes by retail? This is irrelevant. So she talks about the companies that are popular. This part kills me. Robinhood users tend to invest in what they know and use, according to some random person that's the head of investing at Robinhood and a JP Morgan veteran. Okay, whatever. There's no real difference than generations before, and no different. What does this mean? This does not confirm what the article's stating. This has nothing to do with it. So we can look at, I pulled this. So here's this Robinhood index they just talked about, which they don't even link, I don't think. So I don't even know what this is. Robinhood index tracks the performance of the top 100 most owned investments in Robinhood. Okay, so what are people buying? Okay, large cap tech, that doesn't really tell us much, because if you own the broad index, you'd own a lot of that also. So of course, you'd expect to see Microsoft, Apple, Amazon, Tesla. But then look what else. Look what else are retail buying to say they're outperforming? They're buying AMC. Oh, Nvidia. Do you really think these people were buying Nvidia when it was $100? They're buying Nvidia now. Okay. GameStop. Oh wow, look at the amazing outperformance buying this now. Meta, guarantee you they're buying it now. They weren't buying it at $80. This is such a clown. Like this doesn't confirm anything about what the story was written about. So, well, that's an adorable piece. So we can go back. This guy, I don't have to beat the S&P every quarter, says some 50-year-old guy. He invested 401k in retirement, and he has a Robinhood brokerage account. So that data at the top would only look at the returns of his brokerage account. They wouldn't look at the returns. That chart at the top wouldn't look at the returns of his 401k. Okay, well, how convenient. So yeah, okay, even professional money managers have a hard time beating the benchmark. So, but this story has done nothing to confirm or prove why retail, as they claim, Vanda Research's piece, has outperforming the index. There's nothing here yet. So okay, now we're going to go to this chart: individual net purchases of stocks, 21-day period. Okay, this is only 2.5 years. We're only talking about the clown market. Okay, this chart doesn't really matter. It doesn't prove anything. Newbie investors get burned. Okay, but now at the very bottom, we start talking about the downside of retail picking individual stock, because that's all we've cherry picked in data. Large cap tech investors, that's all they've used as examples of retailers outperforming. Okay, what about retail that didn't buy large cap tech companies that have done well? There's no talking about those people that bought Tattooed Chef, GameStop at the wrong time after it already went up, or AMC, the wreckage of AMC. We're going to cherry pick the people that we're saying are outperforming the market. Okay, now she talks about when GameStop soared. Okay, most people, I've read the report from Congress. Most people that bought GameStop during the craze lost money. Most of them saw it skyrocket and bought at the top, and they were stuck with it. Okay, some people made money, but most people lost money on GameStop. And plus, now we're cherry picking data. So she's talking in this article too, like she's like, short term, you can see like there has been brief period recently during the freaking COVID market, retail did really well. They did 2020, 2021-ish, when the market was ruining, retail investors did really well. Again, you're cherry picking your data for a small time period. And then people will extrapolate that if we did well in this 1.5-year window, surely retail can outperform the indices and you don't need them at all. This article is insanely poorly written. This is driving me insane. It's pointless. I'm frustrated with this. And then you got finance YouTubers just, posting this on Twitter. Like, oh, look, picking stocks is amazing. Okay. All right, let's see it. When I see it, save it, and you can just come back later to do it. Tough time find it. Dan doesn't like cherries, clearly. I actually am not. Well, they're okay. You don't get cherries very often at the grocery store. Wouldn't be surprised if the retail investing accounts that outperform the extra people that forgot they had accounts. Most likely, it was probably the people that were dead. But again, that study from Vanda only talked about brokerage accounts, individual stock picking. They left out every other type of investment that retail people can make to say that we outperform. So that's very convenient of them. What was the time period they looked at? The Vanda piece, it said it was like 2014 to 2022. Like I don't have the study to look at it. I'm a Robinhood user. It doesn't relate to me. Article sounds like a bunch of dookie. It is. And they put it on their Twitter. So like they were pumping this article, Wall Street Journal. This isn't something buried on I'm not a Wall Street Journal subscriber. I can get it from a friend. Stats come from DGen investors. Like I hate when a small amount of investors did really well, I'm sure, with these tech investments the last 10 years, no doubt. But then to extrapolate that and then bring that around to everybody, like I can show some other stuff here. So this guy, like this is kind of related, but this was a good article. So this guy's a CPA. So I'm gonna, got to prop up my accounting brethren. So this is like a guy that can outperform, that you would believe. he basically just goes into I think he does a 3 index, like a Boglehead 3 index allocations. So he's just broadly buying everything. He's running a CPA firm, so he's got the income. He just got to put it somewhere. And then he makes one calculated bet on Meta when it was down near $80. And he says in the article, like, he did a lot of research, but he's mostly an index fund. And then he took his shot. So this is like outperformance, I would believe, like this. So yes, no doubt you can, but it's not like for that article to say, oh, retail will outperform. Like, that's how they wrote that article. Like, this is how you could do it. And he even says in this, he when Meta got down to like 80, he said he like looked at it. This guy here. Yeah. I don't typically buy individual stocks. Who bought Meta at 97. However, I was very bullish long run. He saw the dip and then he saw it was a no-brainer. He's like, I did a lot of research in the 10K. So so this is a large cap tech bro that I could believe. I don't believe how many people could do this, what he did with he's a CPA. So kind of related, but here's some of the stuff that I've always seen. This is not a new chart. These are pretty old studies. Oh, where did it go? I zoomed in. Where'd it go? Hold on. Okay. Wow, that does not want to zoom in. So anyways, this is a pretty famous chart that I've showed before. 20 years annualized returns by asset class. So we're going broader. That chart they showed only 10 years. That's pretty recency bias, honestly. Any chart that shows you from the Great Recession to present, it's very short term, because we've been in the same kind of, from 2010, you could argue, until the end of 2021 was the tech boom, right? So it's kind of disingenuous to only show that time period to people that have 30-year runways if you're in your 20s or 30s. But here, like, average investor return, 2.6%. Let's look, and then the S&P 500, 7.2%. This goes from 1998 to 2017. So this encompasses two, the .com and the Great Recession. So for them to say outperformance, cherry picking just specific types of investing with retail, like, and this doesn't cherry pick. This chart represents all return. So that's adorable. There's also, now here's convenient. So they left out retirement, and they left out ETFs and mutual funds. So this is a famous company, and they do this every year. Dalbar's 2023 QAIB report. They look at longer periods. So now we're looking, this represents 1993 to 2022. So now we're stretching longer time periods. And this is mutual fund investing. Average equity fund investor, 6.8% return. S&P 500, almost 10%. So we can see underperformance of the assets that they left out conveniently from Vandar research. How convenient of them. So they took out the underperformance part, because believe you me, people, like, people do some degenerate stuff in their 401ks. Everyone can scream till they're red in the face to buy an S&P broadly diversified or the whole market, so forth. What do people do in their 401ks? I've seen people, they buy like the value funds, like the crap, like trash like that. Or maybe there's like a REIT. They might put all their money in like a REIT mutual fund in their retirement account that has like a 0.9 or 1% expense ratio. Like, I've seen that stuff. So there's crazy stuff you wouldn't even think of till some people ask you that what's in their mutual funds. I'm telling you. So how convenient of them. So let's skip that part in our data. So this drives me nuts. This is from the same place. So this was another from this company, Dalbar. So they did another report. The QAIB reports you have to pay for them. So I can only get like the synopsises. So this was a study. The average equity investors earned 10% less than the S&P 500. Third largest underperformance ever. And this was one of their studies, which looks back to 1990 or 1985. Okay. So again, we're showing underperformance on other more reputable research than this Vandar thing I've never heard of, but I have heard of these people. So that's the same report. So like, yeah, okay, if you bought large cap tech bro, you did really well, recency bias. Nobody's going to deny that. To imply that all retail outperformed because they did this is clownery, and there's no proof of it. I think a small amount of people did and did really well with it, and that skews the return numbers if you look over a larger amount of people. If you do averages instead of like if you do mean instead of a median. I threw McDonald's in here because I can. But yeah, okay. I mean, tech did great the last 10 years. Nobody's denying that. To imply that all retail can outperform the market just because you just pick like a specific type of investment, like what's the next 10 years? I don't know. And neither do you. So freaking clownery. But this kills me. So I just hate people posting stuff and they don't really even, they just crap. It's just crap. This article, and I would tell like the Wall Street Journal, this is like garbage. This story, I can't believe the Wall Street Journal posted this. It's not an opinion piece. It's finance stocks. I mean, even if it was an opinion piece, I'd be like, what the F are you doing posting this garbage? So even on the Wall Street Journal's post, this comment, the story is bogus. They excluded mutual fund ETF holdings and looked only at stocks. Taking Tesla out of the picture reduces returns by 10 percentage points. So unless you bought and held Tesla over the last decade, it wasn't even true. Like, okay. So yes, okay, the people that bought Tesla before it rude did great. But you're skewing the results of these studies when you don't take those huge outliers on statistics out, which I've done classes on statistics. Sometimes there's a huge outlier that skews your numbers, and you either take it out of your results or you would put like a footnote to represent that. But to just leave it in to severely, skew your results is very disingenuous to me. Yeah, picking stocks is easy, bro. Like, oh my god, like I added that one article because I'm like, this isn't how I developed my investing because I didn't have this sort of education knowledge about ETFs and the markets when I started. But this is great. And this is like the core satellite I taught. Like his core holdings is like probably 90% of his holdings, let's say. And then he has the satellite, which is meta for him. I mean, if you piece this into kind of what I think of now, this guy's doing great. He saw his shot. He's always DCing into the broad markets, and then he sees a shot and takes it. So, and he's a CPA, so he's a smart guy, I'm sure. But Days Ramsey said you can easily beat the S&P 500. Oh yeah, just buy tech, bro. Just buy Tesla, big tech stock. You're all set. I mean, I don't mind taking shots. I'm not a boglehead, but that story was ridiculous. I know people that are 100% cash in their 401ks. Yeah. Yeah. So how convenient of their research to take out. Really, there probably are a significant amount. I know a guy that retired. His last 6 or 7 years, he dumped all his investing in his retirement into the stable cash account in our fund. I mean, so you take that out. Okay. Yeah. You're going to skew his performance if he had some large cap tech holdings. But if you added that back in, he'd trash. So always pumping McDonald's. Always will. Always will. Should have bought Apple, right? What are you going to do? So, okay, 25. Okay. Well, that's about it. I don't really have much else with this today. I'm going to go do some more research on some stuff and enjoy my day off. So I am reading this. I think everyone's got this book by now. I swear to God, it's fun. I'm enjoying it. The rabbit part and the assassin. So I'm not going to say who I feel I am, and then I'm gonna read my fancy Schwab magazine that they sent me. That's about it. All right. Well, enjoy your weekend. I started mine early, but have a good day. Talk to you later.